Let's talk about the Federal Reserve and what we are likely to see by way of an announcement when it comes to a rate decision. That happens later tonight. According to polls, 98% of the participants believe that the Fed is going to pause any kind of rate hike this time around as well. And this, of course, coming on the back of fast economic growth in the US and rising personal consumption. You may have to recall here that interest rates are already at a 22-year high. So now what can we expect from the Fed this time around? What will be the kind of statement, the kind of speech that will be made? Will he stay as hawkish, the Fed chair, Jerome Powell? That remains a question. And what sort of impact is the decision going to have on the markets, or at least the commentary? What is that going to bring to the markets, the Indian markets, global markets? Let's find out where expectations are pegged. Peter Cardillo is Chief Market Economist at Spartan Capital Securities. He's joining us with independent Emerging Markets Commentator Geoff Dennis. Great to have you both, gentlemen. Geoff, tell us what you're expecting from the Fed this time, and very importantly, what signals do you see coming from the Fed chair about where they're leaning for the future?
Well, of course, it would be a giant surprise if there was anything other than no change. There's not going to be a rate change. I think that's pretty clear in this meeting. But I think Chair Powell in commentary is going to be pretty balanced, because there are a number of things that could happen over the next 6 weeks to the following FOMC meeting. First of all, we have two employment reports. We have two CPI numbers, so we may get a better read in particular on what additional progress we may be getting in reducing inflation. But at the same time, the risks, are, when we come to December, are I think in both directions. First of all, as your audience will know well, there have been a number of very high-profile wage settlements achieved in the U.S. economy recently, particularly with the auto workers. That could lead to concerns over whether wage inflation could even tick up, let alone not come down further. At the same time, there are no significant signs of slowdown, at least right now, but of course they could be in place more by December. So there's enough uncertainty about where the economy is going. I think that Powell will be very cautious, very balanced, will not want to give a hint, I think, about what they're going to do in December. If you wanted me to drop one way or the other, I would say he's more likely to be a little bit on the dovish side this time around. But for sure, no rate hike today, and a pretty open set of commentaries, I think, about what could happen in December.
Yes. So definitely not as hawkish, perhaps dovish, but as far as interest rates go, they'll stay put. Peter, the worry, of course, is that inflation, though it's decelerating, it is still too high for the comfort of the Fed. And you have the American economy there growing at a very solid pace, despite putting in some of the highest benchmark interest rates that we've seen in the US ever. What does it really mean now for the future kind of action that the Fed would take?
Well, to begin with, yes, the U.S. economy is strong if you measure it by the gross domestic product of the last quarter, but that's past history. And, I think that the full effects of the Fed hikes really didn't impact the economy. And let's not forget that there was a lot of government spending. And so that helped the economy along. But now we're in a new quarter, and we'll be going into newer quarters in a new year. And I think that strength of the economy is going to change. Certainly, we're not going to grow at nearly 5% like we did last quarter in this quarter. So I kind of think that today's announcement, I don't think there'll be any surprises. I think the Fed will stay on hold. They'll talk about high inflation, and they'll reiterate what they've been saying, that perhaps the inflation fight is still not over. But in action, I think that they might actually hint that maybe they are finished with their work. So you might say you're going to get a hawkish statement, but at the same time, a little bit of hope that they're done with their hiking.
Right.
And I think
right.
that's...
So you're expecting more of a hawkish stance. On the other end, you have Geoff, who's expecting a more dovish stance, a more balanced approach at the very least. But Geoff, Treasury yields, they've been hovering around 16-year highs. They're as high as they were in the early part of the financial crisis that we've seen and been part of. What happens next on Treasury yields, according to you? Because that tends to move emerging markets like India's.
I've been wrong on Treasury yields. I expected them to peak quite a bit before they have done. So hopefully this time we're right. I mean, I do think yields are in the process of peaking out around the 5% level. Clearly, I believe what's going on here is now the Treasury market is not just focusing on what the Fed is doing and what the interest rate outlook is and the inflation outlook, but they're also looking at what the supply outlook is. This is why there's been a lot of focus on the refunding announcement that the Treasury has been putting out this week. So I think the risk on Treasury yields is a big increase in supply down the road. But I think if we are at the top of rates, which I tend to think on balance, just about we probably are. And as I think inflation will begin to edge lower again, and certainly will fall much more sharply, I think, as you head into the second half of 2024. And I agree with Peter that I think the economy is going to slow, and it may slow quite dramatically next year. I think you've got to be looking to buy bonds here, at least with some sort of long-term view. So I think the peak is probably in. It's a tough call, frankly. That will, as you rightly point out at the end of your question, help emerging markets at the margin. But the other part of the other shoe, if you like, you need to drop, so to speak, to help emerging markets from the bond yield trend would be a weaker dollar. And the dollar's is stayed very resilient. So yes. I want to see lower yields, certainty about the peak having been reached, but I also want to see a lower dollar. And yes, that's the cocktail we need in markets to get them moving again.
Peter, do you agree that we've reached the peak of interest rates, or at least are we likely to see a prolonged period of elevated interest rates in the US, even if they stay at these levels? The unwinding, of course, could take a long time in the coming. But if that is the case, tell us how you expect the US dollar to move, and gold prices too.
Right, yeah. Well, as far as yields are concerned, I think they've peaked, but that doesn't mean that we can't take a trip back up to the higher end of their trading range that we experienced last month. So, one of the biggest fear was the Treasury announcement, which basically came in line with market expectations, slightly a little bit higher, but nothing that would intimidate the market to the point where you would have auctions, to the point that you would have unsuccessful auctions. So, I don't think that'll be a problem. And if the Feds should hint that there'll be another pause in December, or that they're done raising interest rates, then I think, you'll see a small rally in the bond market. Yields could drop somewhat, right, but I think they stay elevated, because that would be the essence for the Fed to stay on hold and to say, we're done.
Right. Yeah, absolutely. We'll, of course, analyze exactly what is said by Fed Chair Jerome Powell as soon as that decision is arrived at and it is put out. But of course, for the moment, it's where we're leaving it. Peter and Geoff, many thanks for joining us with your perspective. Always appreciate you sharing your views here on ET Now.